So you're getting a home loan, it's decision time and you need to figure out, are you going to have a fixed loan or a variable loan? What's the difference? Now, when you're trying to decide whether to fix your home loan or keep it variable, there's a couple of key things you need to consider. A good way to think about choosing to keep things variable or fixed is you're actually deciding what's more important to you: certainty or flexibility. In this video, that's exactly what I'm going to show you. Hi guys, this is Fabian from the Lending Lab. We are a mortgage and finance broking firm that helps customers reach their goals and take the next step in their financial journey. Before we dive in, it's disclaimer time. This is general information and it's not tailored to your individual circumstances, goals, or needs. You should get advice for your personal circumstances before you make any decisions. All right, so when you fix your home loan, you're making a deal with the bank that favors certainty. And what that means is as interest rates go up or go down, you want the certainty that your interest rate and repayment won't change at all. It's going to be frozen in time at the rate and the period that you agreed to. Now, the banks can offer you a wide array of fixed rates for 1 year, 2 years, 3 years, all the way up to 10 years. And you can choose what feels most appropriate for you. But in exchange, the banks want some certainty of their own. So they're going to say to you, okay, we're going to ensure that your interest rate doesn't change no matter what happens in the market. But in return, we're going to restrict how much you can pay off of this loan, whether you can use features like redraw or offset, and you can't pay the loan off or refinance without there being some penalties. Now, if certainty is not that important to you and you want to access additional loan features, you can consider a variable home loan. A variable home loan offers flexibility rather than certainty. You can restructure, refinance, sell the property without being penalized. In the same way that you want flexibility though, the bank also wants some flexibility. So they're going to say, great, we'll let you make those changes and have that freedom. But if the interest rates change or the general market change, we want to be able to change your interest rate along with it. Now, obviously, if the interest rate drops, you're going to be over the moon. And if you fixed your interest rate, you're going to miss the boat. But if interest rates go up, you'll have to deal with the consequences of rising interest rates and rising repayments, while those with fixed rates will be jumping for joy. So the only way you're going to be able to make a decision between the two interest rate types is if you ask yourself, do I value certainty or do I value flexibility? If the answer is too difficult to get to, there's another option that you can consider called a split loan. That's where you get your home loan and you split it into different parts. One part variable, one part fixed. Now, if you've got a $500,000 home loan, you could split it into two parts that are $250,000 each, or you can split it in any other way that you like. The best decision you can do though is to speak to a professional. A mortgage broker can talk you through the different products, rates, options, and features to find the best deal and structure for you that aligns to your goals. I hope that's answered some of your questions around fixed versus variable loans. If you have any other questions we didn't cover, drop them in the comments below. It'll help us decide what video to make next. If it added value to you and you like what you're seeing, give me a thumbs up and subscribe and it will make my day. Thanks everyone, we'll see you in the next one.